Good morning and welcome to this Wednesday, August 19th, 2020 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, one thing you need to know is it's draft day here at EarningsBeats, and if you're not currently a member at EarningsBeats or you haven't followed EarningsBeats, this is a big day. I'm going to first just show you our website over at EarningsBeats.com, and I want you just to focus over here on our portfolios. Every 90 days, we announce the stocks that are going to go into our portfolios, and we hold them for 90 days. And then 90 days from today, November 19th, we'll do the same thing. We'll replace them and put our top 10 stocks in each one. They're equal weighted stocks, so nothing takes more weight than anything else in the portfolio. So they're 10 equal weighted stocks from 10 generally from 10 different industry groups. We did make an exception last quarter, looking at software stocks. We might make that same exception again this quarter. Still one of the things under consideration right now as I go through today and prepare for this webinar tonight. But if you look at the performance, I think it speaks for itself. I think our strategy of sticking with leaders in leading industry groups is what you want to do. It doesn't work every quarter. We don't have a perfect track record, but I think the numbers here speak for themselves. Since inception, our model portfolio, which is really our flagship, is up 128.56% since November 19th of 2018. That compares pretty favorably versus the S&P's gain of 25.98%. And by the way, you know, we've had a lot of folks scared the last couple of years with the trade war with China. Of course, we took a big hit in the market back in the fourth quarter, especially in December of 2018. And then this year with the pandemic. And coming through all of that, S&P 500 in 21 months is up 25, almost 26%. This is not a bear market. This is not a secular bear market. This is a secular bull market. And when you get into a secular bull market, even some of the things, some of the news that seems so bad, the market just takes it and runs with it. Doesn't matter. Market wants to go higher. And you can fight it all you want. But I think if you look back, I don't know that we could have worse news than we've had the last couple of years. And yet the market just keeps pushing higher. I think that tells us something. But the model portfolio's performance very strong. The aggressive portfolio, which has only been out for 15 months, is up 47.71%. And most of the stocks in this portfolio over the last 15 months have been in small caps and mid cap stocks. And until recently, small caps and mid caps really did not perform well relative to the S&P 500. So it's pretty astounding that this portfolio has been able to outperform by 29 percentage points over the past 15 months. Income portfolio, definitely weaker than the others. It tends to be a little bit more conservative. Dividend payers. It really suffered one bad quarter during the pandemic. And the ironic part is I was trying to be cautious. We actually selected back on February 19th that quarter. Remember, that was the high in the S&P 500. And we turned a little bit more defensive in that portfolio and had real estate, financial stocks. The defensive groups got hit harder than the aggressive groups during the pandemic. And as a result, the income portfolio took the bigger hit. And that's why this group has really been trailing for the most part since inception. And then the latest portfolio we just started in May of this year. So this is the first quarter ending today. The strong AD portfolio, or the strong accumulation distribution portfolio, up 20.6% versus 16% on the S&P 500. So almost 5 percentage points higher in just one quarter. So really nice performance there. We're really proud of our performance in all of these portfolios. And at 5:30 p.m. Eastern time this afternoon, we will be announcing the stocks that go into each of these portfolios. You need to be a paid member, but we do have a 30-day no-cost trial. So if you click on this button here, the green button, you can come down and take a look at it. You do make an initial payment of $7 for 30 days, but we refund you the $7. So no cost for 30 days. You can come in and check out these portfolios and see what we have to say as we head into the next 90 days. All right. Also, if you're not a member at EarningsBeats, the digest, our newsletter, free newsletter, definitely sign up for that. I mean, that's just name and email address, no credit card. You can unsubscribe at any time. It teaches a lot of the things that we talk about, and that really help to shape our portfolios. Relative strength, strong fundamentals, strong technicals. Those are all the things that we really try to focus on in the newsletter. So if you're not familiar with us, you don't want to jump right into our paid service, check us out with our EarningsBeats Digest. Love to have you. All right, let's take a look at what happened on Tuesday, because the market has been unrelenting, especially on the NASDAQ. We have seen, by the way, the IWF versus the IWD, growth versus value, definitely turning right back up again. That's a good sign for the market. For me, it still remains growth. That's going to be a big question going into the fourth quarter, and we're going to talk about that in just a bit. But, just taking a look at it, you can see the NASDAQ closing at 11,210 yesterday, another all-time high. Speaking of all-time highs, it wasn't like we rushed past the prior high, February 19th, but who'd have thunk this back in March? The S&P 500, which was below 2,200 at the March low, has now risen all the way back up to 3389.78. That eclipsed the February 2020 closing high that was back on February 19th of 3386 and change. So we have now reached and surpassed our all-time high from back in February. So the S&P joins the NASDAQ in all-time high territory. Still got some work on the Dow and the mid caps and the small caps, but pretty good start now with the NASDAQ and the S&P in all-time high territory. Communication services led the action on Tuesday, rising almost 1%. Consumer discretionary has just been on a roll. It's got so many strong groups. We'll talk about that in a little bit, but consumer discretionary, very, very strong. Staples, strong on a relative basis, not nearly as strong, but you can see on an absolute basis, consumer stocks doing very well. That also does not, excuse me, that also does not paint a bearish picture. That paints a very bullish picture. Considering the pandemic, considering all the jobs lost, and we continue to see consumer stocks performing well, the market doesn't care about what happened 5 months ago. It doesn't really even care about what's happening right now. Stock market is looking ahead. It's valuing companies based on what the market believes their earnings and their growth rates are going to be, and they're discounting that back using historically low interest rates, which I can tell you from my own personal experience and professional experience, when you've got low interest rates and you're discounting back future growth, strong future growth, valuations go up, and they go up very rapidly, and that's what we're seeing in the market. Technology also strong on Tuesday, and then energy, the weak link once again. That's not really a shocker to anyone. I fully expect energy to get going at some point, but right now, just kind of stuck going sideways. I would expect to run back up fairly soon to test that June high. The group could still be lagging, but we look for wide participation. This is one of the few areas that really hasn't participated. Obviously it's well off the March low, but I'm just talking about the last 5 months, 4 or 5 months. Sideways action mostly. You can see the NASDAQ's not sideways. The S&P's not sideways. Even the Dow's not sideways. They're all going higher. So energy on a relative basis, very weak. All right, 10-year Treasury yield. Let's get the latest here. Make sure I got the latest. Right now, we are down another basis point, maybe just slightly above 1 basis point, 0.656%. So rounded 0.66%. Again, that's down a little over a basis point from where we were yesterday. I'm not a big fan of this moving back down. If we can hold that rising 20-day and bounce, then I think you'll see financials and industrials rebound on a relative basis. If this doesn't hold, then to me, it just tells us we remain in this consolidation, this sideways churning ever since the low we hit back in March. And that's why on a relative basis, financials are struggling. Now, on the other hand, if we can hold this moving average and then bounce right back up, break to a new high, that would be the first time we've seen that kind of behavior in a long time. We didn't see it in June. We had the big breakout, looked great, but then we came right back down below the 20-day moving average. I mean, we barely even got a bounce. Had one day we got back up above the 20 and then right back down, and we had been trading below it for a while. Now we've got many days above, very similar to what we did in June, pulling back, maybe not quite as hard as we pulled back in June, but we're pulling back. And I think it's going to be important to hold these moving averages, especially if you're into any of the interest-sensitive groups. Banks have really been struggling again with the 10-year Treasury yield falling. If you own banks, you really want to see this bounce back to the upside. As far as economic reports, nothing really important out this morning. This afternoon, we will get the FOMC minutes. They come out at 2 p.m. Eastern. We'll see what kind of market reaction, both bond and stock market reaction we see when those minutes are released. But, the market just continues to power forward. It's been somewhat boring on the S&P 500, maybe a little less boring on the NASDAQ. But still, as the volatility just continues to come out of the market, we're seeing prices continuing to rise no matter what happens. And I think that's a good sign going forward. All right, let's move on to talking technically. And one of the things that I do in prepping for this big event tonight and trying to figure out where, which stocks we want to have in various portfolios, my first step, I said leading stocks and leading industry groups. First step is to look at the industry groups on a relative basis to see which ones are leading. This is in technology, computer services. You can see computer services continuing to fall. Just set a new 3-year relative low versus the S&P 500 back in beginning of July. Had a little bit of a bounce and rolling back over. But look at the downtrend. Can I trust this group for the next 3 months? I can barely trust the group for 3 weeks. So no, this is not a group. Now, could there be an individual stock that has been so strong that it's powering forward, not only relative to its peers, but also relative to the S&P 500? Yes. And there will be exceptions where we've got just an incredibly strong stock, even though it's in a weak group, and it will still be in the portfolios. But it's going to have to show a lot of strength. And it's going to have to show that it's being accumulated, that the volume trends are strong. I'm not going to go with anything that looks iffy if it's part of a weak industry group. So, and as I look through these various industry groups, I noticed a few changes from 3 months ago. And, I look at technology, and the same groups are leading in technology. We got semiconductors, very, very strong. This is a relative chart, by the way, that I'm showing you. So this isn't showing you that semiconductors have been going up for 15 months. It shows you that semiconductors have been going up relative to the S&P 500 for 15 months. So back in March, we had semiconductors going down. If you look down, you look at this February-March drop, semiconductors, this is the absolute chart. We went down, but we didn't go down as much as the S&P 500. So on a relative basis, the relative strength continued to rise. So semiconductors look good. If we look at software, my gosh, software has been awesome and bouncing off that 20-day. It's actually getting a 20 week. This is a 20-week relative test, which when you look back, we haven't seen too many of those in the last 3 years. They've been great opportunities to get into software. So do I think software is about to fall apart? Well, it's been up so much, I wouldn't be surprised if we pulled back. But am I going to bet on it pulling back? No way. I'm betting on what the trend has been, which is up. So I still really like software. Computer hardware with Apple, of course, that's going to still be the same. So there you got, breaking out the new relative highs. Obviously, the absolute highs are just off the charts. Apple's been so strong. So that's technology. Nothing has really changed from 3 months ago. Same industry groups leading technology. And I think continue to be the groups that we want to focus on in technology. In discretionary, one stock or one area of the market that I had noted that I'm adding for sure is home construction. Home construction coming off this March low. Back in May, we were strengthening, but we were still below our 20-week moving average or maybe just getting above it. The 50-week moving average, the relative PPO was negative. There were still question marks with home construction back in May. We were just starting to open up the economy a little bit. I don't think too many folks realized what was going to happen with home construction. I think this was one of those uncertain groups. Well, it's not uncertain anymore. Historically low rates, economies have opened up. We're seeing many of these home builders just blowing out earnings. Again, historically low interest rates. That's going to benefit home construction. I think the affordability right now for homes in the U.S., most parts of the U.S. are probably as good as they've ever been. And so the group is benefiting from that. Another group here that's beginning to strengthen, not nearly as much as home construction, but it's specialized specialized consumer services. And here you can see the breakout. Now this one broke here to about a 10-month relative high. So I like that. I like the relative PPO finally turning positive after being negative for a while. And you can see the 20-week relative moving average is starting to climb, not quite yet above the 50. The breakout, though, also occurred on an absolute basis. So had this turn come just below overhead resistance, I might not be quite as bullish. And I'm not crazy bullish here, but I do think things have improved in specialized consumer services. So this is a group that I might take a little bit longer look at now than I would have back in May when we were right here. To me there, the relative PPO is still very weak. We're still in this overall downtrend. We hadn't broken above this relative resistance area. There was a lot of question marks back then. But this surge in July definitely is making me rethink the specialized consumer services group. I would say there's no area, though, that has changed more than industrials. Industrials last quarter, trucking looked good. I'll pull this one up for you. So back in May, you can see right in here, trucking was looking pretty good. We had broken out above the 20, which is above the 50. The PPO looked good, and it still looks good. Truckers continue to outperform. Think about that for a minute. I mean, what do truckers do? They deliver goods. They wouldn't be doing well on a relative basis if the market believed that, we're going to be stuck with this pandemic for a while and the economy's not coming back. Truckers would not be acting like this. So really important to see the transports picking up, and truckers were the first group really to come out of their slump back at the beginning of the year. And even though they went down in March, look at the relative strength. And that was a really good sign. This only tells you part of the story. You're looking at, you own truckers, or, you're watching the group go down, you think it's a bad group. But it looks a lot different when you look at the relative strength. The S&P was getting killed. So yes, truckers were going down. Everything was going down pretty much. But on a relative basis, this was a strong group. So the truckers were strong, and I think they continue to be strong. I think also business support services, I think we also had in there 3 months ago as being pretty strong. May, it was just starting to come up, just getting this breakout, kind of like the specialized consumer services look right now. And you can see they've continued to build. On a relative basis, we actually saw a slight relative breakout, a pullback, but look at the absolute strength. So this is a good group. But these next four I want to show you, and then we'll wrap this up on this part of it, this part of the show. But the next four groups are groups that have, I think, begun to turn the corner in industrials. So you're starting to see more and more leadership in industrials, and that's a good sign. Let's go with first the industrial suppliers. So back in May, we were here, still kind of in a downtrend, starting to strengthen though. PPO just going through the center line. Well, we've added to it. So now it looks much stronger. Relative PPO has continued. We've got more of a sustainable move to the upside. And for me, that's the key. Any group can show strength for a period of time, but I want to see a group that's sustaining it to feel better about owning a stock within that group for the next 90 days. And we're starting to see a little bit more of that here with the industrial suppliers. Railroads. Railroads are a little bit iffier. I'm looking at them more because we've got this just crossing on a relative basis above that center line on the PPO. So the relative PPO literally just turned positive for the first time in about 13 months. We're above the 20 and the 50, but the 20 is still below the 50, but gaining on it. And if you look down here, just got an absolute breakout above that February high. So things are definitely turning more bullish. Might be just a tad early here. Like to see a little bit more strength. But if we can get this breakout on the railroads above this relative triple top, get the PPO into positive territory and see the price action, absolute price action continuing to surge, that would be very bullish for railroads. Building materials and fixtures. This group definitely has come to life. This was where we were back in May. You can see why I wouldn't be too excited back in May. We were in this downtrend, starting to show a little bit of strength, but that's normal. I mean, you can get these little bounces anytime in a downtrend, and then usually they're just followed by more weakness. So this move back up, getting close to that 20-week moving average, that was nice, but I would have expected, if the chances are that it was going to roll back over. It didn't. It went through the 20, came back down, tested the 20, and then exploded, and is now up at about a 9-10 month high, relative high to the S&P. Also, there's your breakout above the February high. Look at the PPO breaking out. Very, very strong. So this group definitely is much, much better than we saw a few months ago. And actually one of my favorite groups in the market right now, delivery services. I mean, look at the 3-year downtrend, and then all of a sudden, just an explosion. When you get a relative PPO at 6 on a weekly chart, I can tell you from doing this for a long time, doesn't happen very often. This is not just a little bounce. This is not a dead cat bounce. This is money pouring into delivery services. So here's your relative or your absolute. In May, this group was at 725. Now we're at 1269. That was just 3 months ago, up 70%. Accumulation is taking place here. We can ignore it or we can participate in it. Now, could we on a relative basis see a little profit taking for a period of time? Sure, but I don't think this runs over. So this is definitely a group that if you looked at it back in May, there's no chance I would have been looking. I don't try to be a hero. I don't try to catch a bottom, call a bottom. I let the market and I let everybody else be the hero. I just want to go with the momentum. I want to see the strength, and then I want to trade the strength. So no way you'd catch me trying to catch something on a bottom, trading at a 3-year relative low to the S&P 500 like this was back in May. But 3 months can make a difference. And, some people say, why don't you include energy? You say you got 10 different stocks, 10 different industry groups. Why don't you have energy? Why don't you have materials? Why don't you have real estate? Why don't you pick one from each individual sector? Well, those sectors have been underperforming consistently for a long time. I don't want to be in those. If I'm trying to outperform the S&P 500, diversifying into weak groups is the opposite way of beating the S&P 500. That is taking you back to the S&P 500. I don't want to do that. So I don't want the delivery services group when it's underperforming. Now I want it. And yes, you could say, well, boy, if you'd bought it back in May, though, look at where you'd be. Well, yeah, but look at all these other points if I'd tried to catch bottoms. Look what happens. I mean, it's hard to say which one is the bottom. All right, so those are just some of the areas, some of the things that I've been thinking about, looking at. I would say also materials have changed quite a bit. Gold mining and mining, I haven't been big fans, probably a mistake on my part. Because those two groups have continued to do well. Now we've got the dollar weakening, which only adds to the strength there. But I'll just point out non-ferrous metals and commodity chemicals also showing some really nice relative strength. And I'm going to be giving them much more consideration in the portfolios this time. All right, let's move on. Let's go to, let's see, what do we have planned next? I think it was just earnings spotlight. Actually, no, I wanted to go into the blog highlights because I did write an article, and this was just something I wrote and published earlier today, this morning. Some of the biggest concerns I have heading into my quarterly draft day. So at EarningsBeats, picking these 10 stocks, what are some of the things that I'm thinking about? One is growth versus value. Is this uptrend going to continue? If it does, obviously you want to stick with what's been working. If it doesn't, if we go into a 3-month, big move down, then those value stocks are going to outperform. So that's a big question and one I've been wrestling with, and we'll talk about later tonight. The dollar. I mean, look at materials. There's the breakout on materials, taking out this double top from 2018 and I guess the latter part of 2019. On a relative basis to the S&P, it's been downtrending for a long time. But since the dollar topped back in March, look at the relative strength in materials gaining. So do we put stock in, no pun intended, but do we put stock in this move to the upside in the short term, or should we be more focused on the long-term downtrend in materials? Interesting question. Talk about that more tonight. And then finally, the transports. I was just talking about railroads and truckers. Transports have a little bit more work to do, but we have seen a massive move to the upside. We cleared the June high, which was important. Now we've got some more overhead resistance that we have struggled with the last 2 years, 2.5 years. So I don't know that we're just going to go charging through transports. We might have a little bit of limitation. Also, on a relative basis, transports have been struggling. I think this goes back a little bit to the 10-year Treasury yield. We need to see that Treasury yield moving higher, because when folks start bailing out of bonds, that's a good sign about our economy. And so that, I think, is what's going to really drive the bull market. I think that we're going to get to a point where everyone's going to realize that, hey, you know what? Things aren't as bad as we thought they were going to be. And in fact, we got a pretty strong economy. And when you see that, that's when money is going to rotate out of the bond market and into more economically sensitive areas. And we're going to see the transports really come to life on a relative basis. We're going to see the financials, the banks, come to life. Don't know that we can count on them right now, and that's kind of what we have to look at for the next 3 months. But I do believe down the road, things are turning. And areas that maybe aren't part of our portfolios this quarter might be pillars of our portfolios next quarter. We continue to evaluate the market as it evolves. All right, let's move on to earnings spotlight. I wanted to go through some of these earnings reports with you. Let's get an update here. Agilent down 2.69%. They easily beat their earnings estimate, 78 cents versus 66. JKHY giving us a lovely parting gift. It's in one of our portfolios. Last earnings report, and it's not a good one. Well, it's not a good reaction. Actually, I think the earnings report's very good. And I wouldn't be surprised to see this gap down and then be bought after today's open. It actually beat 80 cents versus 78 cents, but the stock had been rolling into earnings. I think maybe it's a buy on rumor, sell on news kind of event, but call it what you want. Pre-market, the stock's down over 6%. Cree, down 4.76%. They actually had an 18-cent loss. Market was looking for a 20-cent loss, but stock down anyhow. Lazy Boy, and these were last night, by the way, after the bell. Lazy Boy up 4% after reporting strong results. They were expecting a loss of 26 cents. Came in with a profit of 18 cents. Big move, or big swing there. Lowe's in the home improvement space. Home improvement, very, very strong area of the market. Lowe's crushed estimates, 375 versus 303. Stock up more than 2.5% this morning. Continues to power forward. This Lowe's, I think, is a much better candidate than Home Depot right now. TJX down 5.5% after missing its earnings expectation. They had a loss of 18 cents. The market was only expecting an 8-cent loss. How about Target? Target, big blowout here. $3.38 versus $1.64. The stock had been breaking out, looking very bullish. Now we see why. Great reaction. Target looks great. ADI, this is Analog Devices, up 0.5% this morning. They beat earnings estimates $1.36 versus $1.33. And then the last one I have for you is actually in broadline retail, and it missed 27 cents versus 28 cents, down 17%. And you might say, it missed by a penny. Why would the stock go down 17%? Well, when you get a stock like this built on earnings expectations and you miss, Wall Street can be unforgiving, because not only did you miss by a penny, but those future expectations all of a sudden Wall Street starts lowering those. And when you start lowering those, your valuation goes down. So it could be just a big sell-off here at the open. Maybe it bounces back, but I don't like the company missing its earnings number. So stock getting hit 17% this morning. All right, the three you must see. Let's check this out, and we'll wrap this thing up. First one I want to show you is Lattice Semiconductor. These are actually three companies that you might not be that familiar with that I'm actually considering for our portfolios tonight. Don't know that I'm going to go with them, but these are three that I'm at least considering. I like the accumulation distribution, which has been strong. I like the fact that when this stock broke out back on July 27th, right here, when it broke out, it was breaking also to a 52-week relative high to the semis. And then when it consolidates, this is what stocks do. It underperforms while it's consolidating. But consolidation a lot of times is an opportunity for entry. So this is a stock, I'd be careful if it lost 28 on a closing basis, but otherwise this one I expect to go higher. ACMR, another semiconductor stock. Check this one out. Look at this move over the past 5 months. Look at the volume that's come in. Check out the relative strength. This is what I look for in a stock that goes into our portfolios. Its industry group is going higher. It's outperforming its industry group. It's outperforming the S&P 500. And its industry group is outperforming the S&P 500. You get those four things lined up, generally you're looking at a pretty good stock. And then the last stock I have, this is showing up in the autos. I think it's more of an auto parts stock, but wow, what a move. If there's one thing that really concerns me about this stock, and probably is what's going to keep it out of our portfolios, is that if you go back some of these days, the volume can be light, like only 50,000 shares a day. And when you're talking about 50,000 shares a day at a stock that was $14 or $15, we're not talking about very much dollar volume. And so, having a bunch of members considering buying into a stock that's not very liquid is a problem. So I like the stock, but the lack of volume, just the lack of volume in general is a problem. But normally where there's lack of volume, there's also lack of market makers because they can't make any money. If you're looking at spread on a stock that trades just this few of shares, and then, let's say there were 200 market makers, what does each market maker get one trade every day? So usually a stock like this is going to have very few market makers. And when you have very few market makers, you have a lot more volatility. You could have a market maker that maybe accounts for 30, 40, 50% of all of the volume of a stock. And if one market maker sees all of that volume and can see all of those orders coming in, just imagine the power that that market maker has over that stock. So you got to be really careful on a stock like this because of the lack of liquidity. And this is one of the things that we talk about, first of all, just making it into our strong earnings chart list. We want the volume liquidity to be there. This stock definitely is showing more of late, but after things settle down, we may end up going back down into this. And so that probably will keep the stock off of my list or the portfolios. But wanted to mention the stock anyway, because it has been a tremendous performer. I mean, we're talking about in just the last 2-3 weeks going up 70%. Look at the volume picking up. I mean, there's obviously some folks out there accumulating this stock. But on light volume, don't be shocked if you see 23 print in the fairly near term. I wouldn't be surprised. All right, that's it. I do want to mention one last time, tonight is the night we will be announcing our portfolio stocks. If you're interested, following along, paper trading, investing, whatever. We're not registered investment advisors. I'm not a registered investment advisor. So anyone following these and deciding to trade, you're doing so at your own risk, obviously. You need to really think inside and figure out what kind of trader or investor you are and what your strategy is and how much risk you're willing to take. But the whole point behind these portfolios is to really demonstrate the power of combining strong fundamentals with strong technicals, including strong relative strength. And that's what these numbers bear out. So if you can join us, we'd love to have you. Go in there, click on this. It's a no-cost 30-day trial. Literally, you don't have to pay anything. Come in and get all the picks that we have for tonight. Love to have you join and just check out the service. That's it. I guess the next time that I talk to you all will be 5:30 this afternoon when we go through all of the stocks in the portfolio. So everybody have a great day, and I'll see you later today. Happy trading.